October 1929. The chairman of the New York Stock Exchange told reporters the market had never been in better health. 3 days later, it lost a quarter of its value in 48 hours. 2007. The chairman of the Federal Reserve told Congress there was, quote, no serious risk of a national housing downturn. 14 months later, the global financial system came within hours of total collapse. These weren't failures of intelligence. The men who said these things had the best data on Earth. They simply couldn't see what was already moving beneath them, because every financial collapse in history is built by the same 7 forces. They work slowly, quietly, mostly out of sight, in balance sheets, in leverage, in the silent behavior of the people with the most money. And then, all at once, they stop being quiet. And most of them leave a fingerprint on the chart or on the books, long before the headlines admit anything is wrong. History doesn't repeat itself, but it rhymes. Welcome to Hidden Patterns. Today, we name all 7. The 7th is the most dangerous, not because it causes the crash, but because it makes the other 6 invisible. We'll get there. First, the one that moves fastest. The first force turns a slow decline into a sudden crash. Trust. Money itself is nothing but trust. A shared belief that the number on the screen will still be worth something tomorrow. And trust never erodes in a straight line. It holds weight invisibly, right up until the moment it fails completely. In 1923 Germany, the mark didn't die from inflation alone. It died because people stopped believing in it. The government printed money to pay its debts, and once citizens saw the contract was broken, the spiral moved faster than any institution could stop. Wheelbarrows of cash for a loaf of bread. A lifetime of savings worth less than the paper it was printed on. The pattern is always the same. Years of quiet erosion, then a sudden break. And it's measurable. Confidence in central banks and currencies has been sliding across every major economy since 2008. Force 1 is hidden because trust is invisible while it exists and overwhelming the instant it's gone. But trust doesn't corrode on its own. Something hollows it out from the inside, and that something is usually Force 2. The second force is the one traders fear most because it's the accelerant, hidden leverage. Borrowed money stacked on borrowed money, invisible until it's forced to unwind. In 1929, ordinary people bought stocks on 10% margin, $10 of their own, controlling $100 of stock. On the way up, it felt like genius. On the way down, a small drop wiped them out entirely, and their forced selling drove prices lower, wiping out the next layer beneath them. In 2008, the largest banks on Earth were leveraged more than 30 to 1. A 3% move in the wrong direction was enough to erase them. And in 2021, crypto rebuilt the exact same machine, traders running 20, 50, 100 times leverage, until a single sharp move triggered billions in liquidations in a matter of hours. This is what most people never see coming because leverage is invisible on the way up. It looks like strength. It looks like everyone getting rich. But every unit of hidden leverage is a future forced seller. When the move finally comes, leverage doesn't just join the crash. It manufactures the speed of it. Force 2 turns a correction into a cascade, and it builds up most easily inside a system too complicated for anyone to police. That's Force 3. The third force is a trap every sophisticated market eventually falls into. Products so complex that not even the people selling them understand what happens when they break. Before 2008, banks packaged mortgages into securities, then packaged those into instruments called collateralized debt obligations, so intricate that the models pricing them had to assume one thing could never happen, that housing prices might fall everywhere at once. When that single assumption broke, the failure traveled through every connection in the system faster than anyone could respond. That's the danger of complexity. Every connection that makes a system efficient is also a path for failure to travel. The more sophisticated the machine, the less anyone can actually control it. And the bigger the surprise when it finally snaps. Complexity doesn't cause the crash. It guarantees that when it comes, no one will see all of it in time. 3 forces in: trust, hidden leverage, complexity. The fast ones, the accelerants. The next 4 build for years, including the 7th, the one that hides all the others. If this is useful, subscribe to Hidden Patterns. We decode one hidden pattern every week. Now, back to the countdown. The 4th force is the quietest, and the one I watch most closely. Before almost every major collapse, the people closest to the money begin to leave, calmly, in size, while the crowd is still celebrating. Markets move in phases. After a long climb comes a stretch where the price still looks strong. But something underneath has changed. The big players stop buying and start selling into the enthusiasm. Almost a century ago, a market operator named Richard Wyckoff named it distribution. The smart money handing its bags to the euphoric public. The footprints are there if you look. Insiders selling their own company's stock near the highs. In 2021, large crypto holders quietly moving coins onto exchanges, the on-chain signature of someone preparing to sell, even as headlines screamed prices were going higher. We broke down the exact chart fingerprint. This leaves in another video, link on screen. Force 4 is hidden because it's designed to be. The exit is supposed to look like just one more good day. By the time the crowd understands who left, the room is already empty. When the smart money is leaving and the real selling starts, systems reach for the oldest trick available, Force 5. The debt that never appears in the official numbers. Governments and institutions report the obligations they're forced to, and quietly exclude the ones they aren't: unfunded pensions, healthcare promises, off-balance sheet guarantees, derivatives running through the banking system. The gap between what a system officially owes and what it actually owes is always there in the anatomy of a crash. It's hidden for a simple reason. The people doing the counting have every incentive not to count it. The 6th force is the one that quietly funds all the others, the slow dilution of money itself. The Romans would recognize it instantly. Between 200 and 280 AD, the silver in their main coin fell from over 80% to under 5%, not in one decision, but in increments small enough to ignore, until trust in the money collapsed entirely. We don't clip coins anymore. We print quantitative easing. Between 2008 and 2022, the US Federal Reserve's balance sheet went from under $1 trillion to nearly 9. And here's the part that connects to every bubble of the last 15 years. That flood of cheap money has to go somewhere. It doesn't vanish. It pours into assets, stocks, housing, crypto, and inflates them far beyond what the real economy can justify. The crash of 2021 wasn't really about any single coin. It was the largest wave of liquidity in modern history, finding the riskiest assets it could, and then receding. Force 6 never triggers the crash on the day it happens. It works on a delay, building pressure in prices and inequality until the bill comes due. The question is never whether the dilution matters, it's when. 6 forces. Trust eroding, leverage hidden, systems too complex to control, smart money slipping out, debt no one counts, money quietly losing its value. The 7th force is different. It doesn't add to the pressure, it hides it. In every boom in history, there's a stage the economist Hyman Minsky called Euphoria. The moment rising prices create the illusion that risk itself has been abolished. The leverage feels safe because prices keep rising. The debt feels manageable because asset prices cover it. The complexity feels fine because nothing has broken yet. And the smart money's exit goes unnoticed because who would sell when everything's going up? The South Sea bubble, the Roaring Twenties, the dot-coms, 2007 housing, 2021 crypto. In every single one, the period right before the top was defined by one belief, that the old rules no longer applied, that this time was genuinely different. Force 7 is the final force because it's the final defense mechanism getting switched off. The moment a crash becomes truly inevitable is almost always the moment everyone agrees it's impossible. Here's what makes these 7 so unsettling. None of them are new. They've appeared in remarkably consistent form before every financial collapse on record, from the South Sea bubble to 2008 to 2021. Trust eroding in silence, leverage stacking in the dark, systems no one fully understood, the smart money quietly leaving, the debt nobody counted, the currency slowly diluted, and the euphoria that made all of it impossible to see. 7 forces, the same pattern, every time. So here's the harder question. How many of them can you count in the markets around you right now? That's not a comfortable thing to ask, but it's the right one. Because the people who study these patterns aren't the ones panicking in the wreckage after a crash. They're the ones who understood that what looked like sudden chaos was the final stage of a process that had been running for years. History doesn't warn us with headlines. It warns us with patterns, on the chart and on the balance sheet. And the patterns are always there, if you know where to look. Which force do you think is furthest along right now? Tell me in the comments, and tell me what you're seeing in the data. Subscribe to Hidden Patterns. I'll see you in the next one.